value. Let's welcome in Scott Kroner. He's Managing Director of Small and Mid-Cap Strategy at Citi Investment Research. Scott, this is a huge debate right now. Where do you think it makes most sense for investors to put their money?
Well, so look at, we have a positive outlook on U.S. small cap into the end of the year. Our target for the Russell 2000 is about 2,400, which is up 8-9% from here. And what specifically we're getting at here is that the bullish case for small cap increasingly is a function of where forward growth earnings expectations are going. So this is the earnings setup as we go into 2022. So where we're maniacally focused on this point is making sure we've got conviction in companies where there is that growth driver in the forward 12 to 18 months ahead. And that's what we're looking to differentiate around.
All right, so that forward growth driver, as this research points out, hedge funds seem to have more conviction in the reopening trade, but also in some pandemic thematic plays, whereas some of the more mutual funds seem to be hedging their bets a little bit. And that kind of makes sense. I mean, in some ways, you're paying hedge funds to take big, risky bets and hopefully to deliver big. So should we be encouraged by the idea that they're kind of hoping that the reopening, that's the place to be?
Yeah, I think that's the case, right? So when you look at the use case for small cap or the Russell 2500, let's say, by hedge funds, they're going to go down into our asset class for alpha purposes, right? And to accentuate conviction in a broader theme or trend. So in this case, we've seen them come down. We kind of call out the consumer discretionary area as an area where we believe they can differentiate. And again, I think it speaks to this ongoing and growing recognition that there's a consumer spending wave that can continue for some time longer. So that's an important delta in terms of how we think about the hedge fund positioning. On the other hand, your traditional long-only mutual fund investors, they have to deal with a different dynamic. And in this case, for small cap, it's been the issue with healthcare, where U.S. small cap healthcare has been lagging pretty significantly since the February timeframe. So again, there no surprise to see them reduce exposure to those names, redeploy that into other what we deem more economically sensitive exposures, financials, industrials, energy, materials.
One final question on healthcare itself, actually, so I'm glad you brought it up. We were speaking to Alethea Young the other day about the sort of divergence between a couple of the biotech ETFs that she said came down to the lack of M&A for a lot of small biotech companies because we've been so focused on the pandemic. But we just yesterday had Pfizer acquire Trillium. Is there maybe sort of a change in sort of behavior underway that could make healthcare catch up, or do you think there are other dynamics that are going to keep holding it back?
This is great. So keep this in mind. Russell 2000, you've got 350 stocks that are categorized as either biotech or pharma, right? So essentially, what's going to drive the risk on allocation towards that sector? It's either going to be perception around the FDA approval process, or it's going to be the view that there is an M&A scenario that can play out. Obviously, not all the companies can be M&A, but the recognition that there's implicit value in these companies and their drug pipelines can drive some enthusiasm around that sector.
Yeah, absolutely. Very interesting. One of the many places to watch. Scott, thanks for your time today.
You bet. Anytime.
Scott